Ahoy, podcast listener. This is your host, Bodhi. I had already recorded this week's episode, and then something amazing happened today. Number one, we got a new patron, Scott. Scott, thank you very much for becoming a patron of the show. It really means a lot, and I really appreciate it. But we also had someone increase their pledge, which was Gene. Gene just became a patron, and he's already increased his pledge. Thank you, Gene. It's very kind. I do want to remind everybody that if you do give more than $1, that's always appreciated, but you don't have to. I want to keep this affordable for everybody. But thank you very much. All of the money goes back into the show. None of the money goes back into my own personal pocket to pay bills or anything like that. My wife and I have jobs, and that's what we pay our bills with. So none of that is paid with your money. It just goes to make the show better. So thank you, thank you, thank you. I really appreciate it. It means a lot. All right, let's jump into Tesla's Q1 2023 earnings call. Hello, everyone, and welcome to Kilowatt. My name is Bodhi, and I am your host, and we are going to talk about Tesla's Q1 2023 earnings call on this episode. I'm really excited to get to it. So let's jump in to Elon's opening remarks.
Model Y became the best-selling vehicle of any kind in Europe and the best-selling non-pickup vehicle in the United States. And this is in spite of a lot of challenges in production and delivery. So it's a huge credit to the Tesla team for achieving these great results. It is worth pointing out that the current macro environment remains uncertain. I don't think I'm telling anyone anything people don't already know, especially with large purchases such as cars. And while we reduced prices considerably in early Q1, it's worth noting that our operating margin remains among the best in the industry. We've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin. However, we expect our vehicles over time will be able to generate significant profit through autonomy. So we do believe we're laying the groundwork here, and then it's better to ship a large number of cars at a lower margin and subsequently harvest that margin in the future as we perfect autonomy. This is an extremely important point.
So we mentioned on our last show that Tesla had lowered prices on their vehicles 6 times in 2023, which is great. Right now, the Model Y is calling to me at $49,900. I actually had a discussion with my wife today about maybe not getting the Cybertruck and getting a Model Y instead. Those are ongoing discussions. But anyway, his point is that they would rather sell more cars and have more of an ability for them to sell full self-driving or enhanced autopilot than to sell a few cars and not have that ability to have those to generate income after somebody buys the vehicle. I do think that $15,000 is way too much money for full self-driving, especially with all of the investigations that are going on with Tesla right now and where full self-driving is in terms of development. It's not there. And we might get a small admission from Elon that it's not quite there, but we'll see. We'll see. I don't want to give anything away. All right, let's jump back in, and Elon's going to start talking about Cybertruck.
See, regarding the Cybertruck, we continue to build alpha versions of the Cybertruck on our pilot line for testing purposes. It's a great product, and we're completing the installation of the volume production line at Giga Texas, and we're anticipating having a delivery event, a great delivery event, probably in Q3. As with all new products, it'll follow an S curve of so production starts out slow and then accelerates. So the Cybertruck is no different. So it's there's a tremendous amount of demand for the product, obviously. It is, in my view, a fantastic product, a Hall of Famer. But as with all new products, it takes time to get the manufacturing line going, and this is really a very radical product. It's not made in the way that other cars are made. So let's see. With regard to Megapack, we're making great progress. Our energy storage deployment reached nearly 4 gigawatt hours in Q1. It's by far the strongest quarter ever. And this growth was achieved thanks to the ongoing ramp at our Megafactory in Lathrop, California. There's still some way to go to reach the full run rate of 40 gigawatt hours per year. And then we additionally announced the start of a new Megafactory in Shanghai. So we're as we've expected, the stationary storage growth actually will significantly exceed the vehicle growth.
Let's talk about Cybertruck first. Elon is going to get asked the question when we're going to get more details on Cybertruck. And his answer, this is later on, his answer is that there's going to be a handover event late Q3 2023, which we're expecting that to be September, and we'll get specs and pricing at that time, which I think is absolutely ridiculous, and it makes me mad even thinking about it, if I'm being honest. But I've already complained enough on this show about that, so we're going to move on to the Megapacks. SRP, Salt River Project here in Arizona, it's an electrical utility. They're building a big Megapack site in Avondale, Arizona, or right around that area in Avondale. We're actually going to talk about it in one of our news episodes, so I won't say too much here. But the Megapack and PowerPack, those are very popular products for sure. Next up, Elon's going to tell us a little bit more about autopilot and full self-driving.
Regarding autopilot and full self-driving, we've now crossed over 150 million miles driven by full self-driving beta, and this number is growing exponentially. This is a data advantage that really no one else has. Those who understand AI will understand the importance of data, of training data, and how fundamental that is to achieving an incredible outcome. So, we're also very, very focused on improving our neural net training capabilities, as it is one of the main limiting factors of achieving full autonomy. So we're continuing to simultaneously make significant purchases of NVIDIA GPUs and also putting a lot of effort into Dojo, which we believe has the potential for an order of magnitude improvement in the cost of training. And Dojo also has the potential to become a sellable service that we would offer to other companies in the same way that Amazon Web Services, offers web services, even though it started out as a bookstore. So I really think that the Dojo potential is very significant. In conclusion, we're taking a view that we want to keep making and selling as many cars as we can. Despite this being an uncertain macro environment, this is a good time to increase our lead further, and we'll continue to invest in growth as fast as possible.
I've said it before, and I'll say it again, full self-driving is way too expensive. Let's go ahead and move on to Tesla's Chief Financial Officer, Zachary Kirkhorn, and he is going to give us his opening remarks.
I want to start by congratulating the Tesla team for record vehicle production and deliveries. And I also want to congratulate our energy storage team for record volumes as well. There's three main points I want to make. First, automotive gross margin and operating margin reduced sequentially, but as Elon mentioned, these remain at healthy levels. In particular, automotive gross margin was impacted by a few factors since our discussion on the last earnings call, which include additional action taken in the second half of the quarter to improve vehicle pricing, and one-time items, most notably warranty adjustments on older S and X vehicles, as well as increased deferred revenue for certain autopilot features as we transition technologies. Progress on vehicle cost reduction continued in Q1 with meaningful improvements on logistics and the beginnings of some commodity cost reductions starting to be realized. Per unit costs for Austin and Berlin improved as well, driven by record volumes. However, these factories still provide a margin headwind and will likely continue to do so until after we reach and stabilize at our intended volumes. Note that Q1 was our third quarter in our multi-quarter plan to move to a more regionally balanced mix of build and deliveries. As I've mentioned previously, this results in lower deliveries than production within a quarter due to a higher volume of cars in transit at the end of the quarter and has an associated impact on quarter-ending free cash flows. This was particularly prevalent in Q1 for S and X as we began exporting cars for international deliveries. Second, our storage business is starting to take shape, and this is exciting to see after many years of investment and focus. This business is growing as a percentage of the company's revenue and reached its highest level yet in Q1, driven by an increasing rate of deliveries for our Megapack products. We are also making progress on storage profitability, generating our highest gross profit yet in the quarter. Third, I want to reiterate the philosophy by which we are operating the business this year. Our approach is to grow volumes as quickly as possible in both our vehicle and energy businesses. We plan to continue to invest heavily into our future plans, which include the Cybertruck, next generation platform, in-house cell production, energy storage business, and our autonomy and AI-enabled products. And we plan to do this while keeping the business financially healthy and industry leading. To accomplish this, we need to remain focused on cost efficiency and working capital, and in particular, unwinding the strategic inventory buildup left over from the pandemic.
All right. I don't normally comment on Zach's opening remarks because I'm not qualified to talk about any of the stuff that he talks about. But some of the things that he said in there in terms of future plans, this is why this is why I cover the earnings calls, because that gives us a glimpse into the future on how to pick stories and what's going to be important and what's not going to be important. So he mentioned the Cybertruck, the next generation platform is going to be really important, which I would agree with. In-house cell production, their energy storage business, autonomy, and AI-enabled products. So going forward, or at least for the next 3 months, those are the things that we are going to concentrate on when it comes to news. All right, now we have our say.com questions, which come from retail investors. And the first question is, let's see, what is the process to make auto pricing adjustments? What variables do you consider? And how frequently do you review the prices? I think this is a great question. So let's go ahead and get into the answer.
Yeah, I think this was not something that we can really talk about. It's just we do our best to evaluate the production output, macroeconomic conditions, and we make a decision. But it's unless there's something you'd like to add, Zach.
No, I think that's right. I mean, as a team, we review where we stand globally on a weekly basis, and certainly can't get into the details of the reasons why certain decisions are made. But it is something that's very actively managed by a subset of the leadership team.
Well, that was not helpful. Let's go ahead and go on to the next question. I promised that. I just put that in because I thought it was funny. I won't be doing that for every question. The first question we're going to cover is, how well are the 4680 cells meeting the expectation described on the battery day? And how long will it be until the cells meet those goals? And initially, you're going to hear from Drew Bagliano, Senior Vice President of Powertrain and Batteries.
Yeah. So on Battery Day, we established a cost down roadmap through 2026 across 5 areas of effort. There was the cell design we discussed, anode and cathode materials, the structural pack concept, and the cell factory itself. And we've been making progress across all of these aspects since then. For the cell factory, the Texas 4680 factory, we are partway through building and commissioning and installing and operating. Will be 70% lower capex per gigawatt hour than typical cell factories when fully ramped, in line with what we described on Battery Day. And we're continuing to further pursue densification and investment reduction opportunities in future factory buildouts like in Nevada. On the cell design, we're in production with not only the first generation tablet cell we unveiled on Battery Day, but a second, more manufacturable version in Texas today. On the cathode material side, we have a number of activities underway per the Battery Day roadmap. For lithium, our Corpus Christi lithium refinery breaks ground this May. Our goal is to start commissioning portions of the facility before the end of the year. The refinery uses the sulfate-free spodumene refining process with reduced process costs, no acid or caustic reagents, lower embodied energy, and actually produces a beneficial byproduct that can be repurposed in construction materials. We discussed all of these concepts on Battery Day. Same with cathode precursor. We've successfully demonstrated a lower process cost, zero wastewater precursor process that we described on Battery Day at both lab and pilot scale, and are in the detailed design phase for incorporating this technology into the front end of our Austin cathode facility. On cathode production, we are 50% equipment and 75% utilities installed at our new cathode building in Austin, with our goal to begin dry and wet commissioning this quarter and next quarter, with a target to produce first material before the end of the year. Structural pack, we saw big improvements with pack manufacturing with the 4680 cell and the structural pack concept, 50% lower capex and 66% smaller factory for the same output in gigawatt hours per year. We do believe structural as a concept is a good one. It's simpler. We'll continue to structurally load the cells and use the pack as the floor of the vehicle, while iterating the design to closer to B-level execution of this A-level architecture in future programs. And zooming out for the 4680 team, Q1 was all about cost and quality. We made significant improvements in both areas. In Texas, production increased 50% quarter over quarter. Through yields increased 12%, and Cato peak rate increased by 20%, and through yields improved by 20%. Altogether, the team accomplished a 25% reduction in COGS over the quarter, and we are on track to achieve steady state cost targets over the next 12 months. And going forward for the rest of the year, the priority one is yielding cost for the 4680 program as we steadily ramp production ahead of Cybertruck next year.
All right, that answer's all well and good, but what I really want to know is where they're at on that progress bar. Are they 50% of the way there? Are they 80% of the way there? I understand different processes. They may be in different places, like they might be struggling in one area and really progressing in another, but altogether, you can't get the product done until you figure all this stuff out. So I'd really like to know, in terms of the 4680 battery cell and all of the features that they promised, where are we if you're going to use a progress bar? The other thing that he said that I thought was interesting is that they're developing a second, more manufacturable 4680 battery cell. So a second cell that's easier to manufacture. That's interesting to me. And I wonder if there's any differences in terms of capabilities or if it's just easier to manufacture. But it sounds like the 4680 cells are heading in the right direction. And our next Say.com question is, can you give updated specs and pricing for Cybertruck and any new features that will make it to production? I'm just going to give you a spoiler alert right here. You're going to be disappointed, or at least I was with this answer.
Well, I think we'll save that for the Cybertruck handover, which will hopefully be around the end of Q3 this year. And one thing I am confident of saying is that it's an incredible product. It's a Hall of Famer, I think. And a product like this only comes along once in a long while. So people will not be disappointed at all. It's amazing.
Well, I'm not going to belabor the point, but I'm disappointed. I feel like they should have a better answer than this. Next up, we have our analyst questions. So let's go ahead and jump into our first one, which has to do with the FSD take rate.
Hi, thanks for taking my question. I was wondering first if you could discuss your FSD take rates and whether you've seen any significant positive or negative change there. And also, given that you've reduced the prices for your vehicles, do you think you need to do that for FSD as well? Thanks.
Well, I'll decline to answer the details on the FSD take rate, but it's a tricky pricing question because the value of a car that is autonomous is enormous. So in a way, the price right now is an option value on an autonomous vehicle, and that value is that will ultimately be very significant. And it's really yeah. I mean, for those that are using the FSD beta, I think you can see the improvements are really quite dramatic. There'll be a little bit of 2 steps forward, 1 step back between releases, and for those trying the beta. But the trend is very clearly towards full self-driving, towards full autonomy, and I hesitate to say this, but I think we'll do it this year.
I don't hesitate to say this. They won't. Elon says this every year. He says it pretty much the same way. Anybody who's driven a car with autonomous features, with FSD features, would agree that we're close. They're not. I don't have any hate for that in terms of, like, it's hard. I get it. I understand why they're not there. However, they're not there. As far as FSD price cuts go, if Tesla's FSD take rates were really good, then that would be something that Tesla could actually crow about and say, hey, look, we're making all this money from this service over here. But they're not. So I don't think the take rates are very good. I could be wrong on that. I don't have any insider information, so I might be 100% mistaken, but I don't think I am. And FSD is not complete. So when he says that you can't, the value of a car that is autonomous is enormous, you can't say that when you don't have a car that's autonomous. If I owned a 2016 Model S with hardware 2, I can't resell my car at a higher price because of a promise that you made in 2016 that didn't end up working out for people who purchased hardware 2 cars. You just can't do it. So I'm not trying to be testy about this, because I think that this is a hard problem to solve. But on the other side, I think Elon grossly overestimates the value of a promise that has not been fulfilled to this point. All right, our next question is about Tesla's pricing strategy and a little bit of robotaxi and some clarification on that.
Perfect. Thank you so much for taking my question. Maybe a first question for Elon on your pricing strategy. So if I understand your message, you're saying, Tesla feels it's worth maximizing the volume, increasing the size of the fleet as fast as you can, because you'll be able to monetize this over the life cycle of the vehicle. Could you be a little bit more specific around ways you would be able to monetize sort of like this existing fleet in the future? Obviously, I think autonomous seems to be a big piece of it. By my understanding was that robotaxi would probably be for the next generation vehicle, not the existing one. So I guess in which ways would you monetize it?
Sorry, the robotaxi terminology can be a bit confusing because that's sort of like a generic term for our next generation vehicle. And we obviously are working on a next generation vehicle. It's going to be very compelling. This is just not the time to talk about it in detail as a product. So we internally call it robotaxi, but really all of the vehicles that have hardware 3, which is the vast majority of our fleet, we believe will achieve full autonomy. So they will be like a Model 3 or Model Y would be a robotaxi, a robotic taxi. So yeah, that's to the best of my knowledge that we believe the current hardware can achieve full autonomy.
Understood. And then maybe a question for Zach, back on the automotive gross margin. So I guess a few months ago, even after major price cuts, you felt pretty strongly that 20% automotive gross margin was still probably a reasonable floor. Obviously, the macro has gone worse, and additional price cuts have happened. Is there anything else that has changed in terms of the outlook? Is it just the macro deteriorating? Is it the competitive landscape? Anything else that sort of like makes you think differently around the full year? And is there is there a way, therefore, to frame a floor?
Yeah. About half of the miss against that previous conversation last quarter is attributed to adjustments we made in pricing in the second half of the quarter. I guess you could argue that lowers the floor in a sense. We've also made pricing adjustments so far this quarter, so that brings it down further. About the other half of the miss in Q1 was attributed to things that are non-recurring. So I mentioned these in my opening remarks. It's a warranty adjustment for cars that were previously produced, but not part of the pedigree of cars we're building now. And some autopilot-related deferrals as we make some technology changes here that those deferrals should get recognized once some of the software catches up. So those two things are non-repeating. So hopefully that helps answer your question.
Yeah, I mean, there's really two macro factors that are tricky. The biggest being the interest rate. So if there's a very high Fed rate or interest rates are very high, that is every time that the Fed raises interest rates, that's equivalent to increasing the price of a car. It makes the cars less affordable because people are able to buy cars as a function of what they can afford on a monthly basis. So it's just almost directly equivalent to a price increase is any kind of interest rate increase. Then the other factor is whenever there's uncertainty in the economy, people will generally postpone new capital purchases like a new car. This is a natural human reaction. So if people are reading about layoffs and whatnot in the press, they're like, well, they might be worried about they might be laid off, so then they'll be naturally a little more hesitant than they would otherwise be to buy a new car. Now this is just the nature of the auto industry. But there will be a tremendous amount of pent up demand for new cars. So, but it goes through cycles.
Let's tackle Robotaxi first. Do you think that Hardware 3 will hit full autonomy? I think you already know what I think. I'm curious to know what you think. Because Elon says that they should, he just said it, that they should, but will they? And if they can't, will there be some sort of class action lawsuit against Tesla based on what Elon has said in the past? Because he's been pretty vehement that Hardware 3 is going to get us to autonomy. And right now, we're creeping up, and Hardware 4, Model S and Model X have it. I wouldn't be surprised if Model 3 and Model Y get it soon. So I'm curious, do you think this is going to work? Do you think Hardware 3 will hit full autonomy, leaving robo-taxis out of it, whether they'll be used for robo-taxi or not? Do you think they'll be able to hit Hardware 3? Because publicly, Elon has said that Hardware 3 will be robo-taxi ready. Bodie, BODIE at 918digital.com. And in terms of price cuts, we heard Zach give his financial stuff. Elon mentioned that the interest rate is really high, which it is. As somebody who's looking at buying a new car sooner rather than later, it looks like. But who knows? I say that and then I back off from it because I really want a Cybertruck. But the interest rate is really high. And the economy, people are getting laid off. And my job is fairly stable. I don't think I'm going to get laid off. I only have 4 more years until I can retire. My wife's job is pretty stable. So based on those things, I think we're okay. I'm not really worried about that so much. I wish the interest rate was a little less. Next up, we have another pricing question.
Thank you. Just on pricing, a lot of pundits talk about pie and losing share or gaining share, but how do you guys look at pricing versus the EVs or the ICE vehicles, or does that not come into the equation? Sorry to ask about pricing again. Thank you.
No, and it's really just like we're every day we get a daily real-time update of how many cars were ordered yesterday, how many cars were produced yesterday. We must have if there's a company that's got more real-time data than Tesla, I'm not sure. I'm not sure there's any company on earth that has better real-time data than Tesla, except maybe SpaceX, Starlink. So because like we don't have to, for the other car companies, they will make the cars, send them to the dealers, then the dealers will sell the cars, and and then it takes quite a long time for them to get the data back to actually figure out how many cars were sold. Whereas we know how many cars were ordered yesterday throughout the world. So our fingers on the pulse is real time and does not have latency, whereas the other car companies have a lot of latency in their data, as does the government. The government has a lot of latency in their data. So we're just looking at and saying, okay, what does it take to achieve a clearing price for our vehicle production? And then we make a pricing change and we see what happens immediately, and adjust course. So we're adjusting course, and we're thinking about it literally every day, 7 days a week. Every 7 days a week, I look at that email, and so does the rest of the team. And we try to make the least dumb decision that we can. And on balance, I think our decisions are pretty good. Sometimes they'll be, dumb, but on average, they're, I think, better than the rest of the industry.
Just to add on the question about EV market share or ICE, this comes up a lot. I think a lot of the public debate is around this concept of EV market share. We don't look at it that way. I mean, we look at it as market share of cars. It's the car market, not the EV market. And actually, the mission of the company requires internal combustion engine cars to be switched over to electric vehicles. So that's what we pay attention to.
Yeah, I've said that last time too. You guys got to stop looking at it as the EV market. It's how many cars are we selling? Just start looking at it that way.
All cars will be EVs. It's it's gonna. I've said this for a long time. We'll look back. I don't know. Assuming civilization's still around in 20 years, we'll look back on internal combustion engine vehicles the same way we look back on external combustion engine vehicles, which, like a steam engine. A steam engine is an external combustion engine vehicle, and there's still a few around. They're kind of quirky and kind of cool collector's items. That's how gasoline cars will be in the future.
I don't really have anything to add to that other than I always look to make the least dumb decision every day. I don't. This really spoke to me because I don't think I make, particularly smart decisions. I just try to make the least dumb decision. This is kind of my mantra. So I think everybody should strive to make the least dumb decision every day that they can. I like the way that Elon put that. And then the next thing is Tesla looks at the car market as a whole. Now, it's not EV versus EV. It's car versus car. And I agree with him 100%. Our next question has to do with cost structures. It's a little bit nerdy, but I do think it helps us when it comes to predicting future prices for Tesla vehicles. And then also, I think it helps us understand the supply chain a little bit better. So let's listen to that question.
Thanks so much, guys. Can you talk a little bit about how much of the actual cost structure is variable, on these vehicles, and if you could give us a range on plus or minus the lithium cost within those contracted volumes that you're seeing?
Well, I think you have to. I'll again, we'd really love to have a crystal ball here, but we don't have it. Depending on what time scale you're looking at, the most of the car is variable. So most car costs is variable. So, and probably, if I were to guess, I think we will see improved costs from suppliers. I think we will.
Yeah.
That is our expectation.
Yep, and we're already starting to see that, Elon. I think you had mentioned before we anticipated a crash in the lithium prices. and some of that has flowed through by way of lithium carbonate reductions into battery cost. And the same thing will happen with lithium hydroxide. The length of the supply chain matters also, because what we're talking about is very far upstream. So by the time it makes it into the battery that ends up in a car, it'll be several months. But beyond just the commodity pricing, as Zach mentioned earlier, we're also very focused on other metrics that make production very efficient. So, for example, detention and demurrage, air expedites. I think our air expedites are down 90%. Detention and demurrage is down 93% from the peaks. That can be hundreds of thousands of dollars per vehicle. So we're sort of attacking all vectors and becoming very efficient.
All right. I don't have much to add on that other than this is something that we're going to hear other automakers talking about as well. So keep that in the back of your mind when we cover the other earnings calls. Let's see here. Next up, we're going to hear a little bit about stationary storage.
Okay. And then my follow-up is really around stationary storage demand on the utility scale. I mean, obviously, there's a gigantic queue for interconnection in the U.S. And can you talk about the volume of quotation you're seeing at this point around stationary storage for that renewables queue on a global basis, and how much of that is converting into actual sales?
Drew, you want to take that?
I mean, I don't. That's also not exactly how we look at it, really. We're not we're not engaged in the interconnection queue. Like, we're focused on ramping Megapack as quickly and efficiently as we can, and we have visibility into the pipelines of a variety of different renewable energy and just pure stationary storage developers, and we also develop our own projects. And we're mostly just we're being selective and trying to pick the projects that best fit our mission and our objectives.
Yeah, this is not a product call, but we'll have something. I mean, we're making improvements on many fronts, including Megapack. So I think some of those improvements will improve the speed at which you can connect the Megapacks to the grid.
We got a little tip of the hat, or maybe a glimpse of what's to come with Megapack in terms of the underpinnings and making it easier to connect to the grid. Don't forget, we also had a story not that long ago, maybe a week or two ago now, where they were talking about Powerwall 3. It's about time for an updated Powerwall, so that's probably in the works as well. So it sounds like they're going to make a product announcement on energy at some point in the near future. I would guess 2023 would be when they do this. We're hearing more and more and more about their energy solutions. So it makes sense that since we're getting all these rumors and these updated stories, that maybe there is the announcement on its way. Next up, we're going to hear about opening up the charging network.
And then the company has spoken at the Investor Day and some of the past conference calls about opening up its vehicle charging network. Can you speak to some of the feedback you've been getting from both Tesla owners and non-Tesla owners, and how the ramp of the charging network may progress from here? Thanks.
Drew, you want to take that?
Yeah. So as you may have seen, we opened our first V4 post in Europe and our Magic Dock post in North America in Q1. And that is, indicative of the direction we're heading with, universal compatibility for all vehicles, no matter where the charge port is, et cetera, in all major markets. And we're going to continue to roll out those sort of improved offerings as we build new stations. We're always balancing like our ability to serve our own customers with our ability to serve new customers when doing that. I think we've been able to balance it rather well. For example, in Europe, 50% of all of our supercharging stations are open to all EVs, and we've been able to do that without any increase in wait times at all for anybody. So we're going to continue to take a similar approach as we do this in North America and China over the coming quarters.
Don't really have anything to add there. This next question, I don't think it has much to do with Tesla, but it is an interesting question, so I'm going to leave it in. So let's go ahead and listen in.
So now that you've gotten to know the Twitter architecture kind of intimately well over the past 6 months. What can you tell Tesla stakeholders about how an X.com or super app could be potentially accelerative to Tesla's business model?
Well, I don't know. I guess it could make it potentially make it easier to buy cars. But we're straying somewhat off topic here because this is
okay.
Tesla.
All right.
I think there's some benefit. I think probably there's some benefit. Yeah, sure.
I get it, Elon. So just as a follow-up on manufacturing, you're a student of history, and
Yes.
you'll know that back in 1913, Henry Ford introduced the moving assembly line in Highland Park, Michigan, and the price of a Model T, which had already, been undercutting cars around the time, fell another 70 or 80%, and hundreds of rival car companies went bust.
Yeah.
I'm wondering if history is repeating itself here, Elon, and that the recent pattern of cuts with you is way ahead of the cost curve compared to competition, or is this? It seems like it's a calculated strategy, not just in reaction to competition or changing supply demand in the market, but could we catalyze some Darwinian forces in the EV market?
Well, I mean, we're not trying to say take pricing actions in order to be deliberately undermine competitors or anything like that. We really don't think about competitors that much. We just look at, do people like our cars? How can we make the product better? Can they afford our cars? The sort of the things like improving service and whatnot. But like I said, we do have this unique strategic advantage that we're making a car that if autonomy pans out, and we think it will, where that asset is actually will be worth a hell of a lot more in the future than it is now. So it is technically possible to sell it at zero profit, but still have the net present value of future cash flows associated with that asset be very significant.
Yeah. And service and charging and insurance and all of these other ongoing revenue streams that other companies don't have.
Yeah.
Certainly, we want all EVs to succeed too. We just want to say that we're not in like some malicious attack to try to just crush everybody.
Definitely not. We're like opening up superchargers. We've made our patents available for free. So it's like we're trying to be helpful here, So we're not out to sort of destroy competitors or anything like that. We're trying to help competitors, frankly, in any way that we can.
Do you think there's a world where Tesla will sell their vehicles at cost, just hoping that you'll buy their services? I mean, there might be a world where that happens. I highly doubt it, but there might be. I know that they were just saying technically that we could do this, but it is an interesting thought. And really the only way that would work on any level would be for Tesla to figure out autonomous driving so that it's full level 5 autonomy without any issues. Because otherwise, why would you buy the services? I know that they have, the $76 a year or $96 a year connected services plan. They have insurance and things like that. But really what's going to make them the most amount of money is the autonomous features in the vehicle. And if another car company comes around and makes a vehicle that's just as good as a Tesla and doesn't charge you for those features or charges you less, because they just become standard, that would be a problem for Tesla in this very imaginary scenario that we're talking about now. Like, I want to be clear, this is just pretend, not real. Don't email me on this. I won't answer. I mean, I'll say hello, but I won't answer well, actually, if you do email me, because it's pretend. All right. Our final question is whether or not it makes sense as Tesla grows to maybe adopt a dealership model or something similar, basically change the way that they are doing business. So let's go ahead and listen in.
Yes. Good evening. Thanks for taking the question. It's slightly longer term. I completely agree with your comments that we should look at Tesla in terms of auto market share, not EV market share. But I'm just wondering, as you build up the market share globally, is there a limit to the direct selling business model as you practice it? And should we think about going forward, you need to look into the agency or using importers to basically develop market share more smoothly, I guess, globally. And so, in other words, is there kind of a sell by date for the direct business model as you practice it today?
It seems to be working well so far.
Because we hear different feedback from customers who miss the human interaction or unhappy with the service, and I'm just wondering if you're seeing some growth pains in there that would lead you to change. You're not seeing that.
Well, I mean, there are, since we're always going to have some growing pains where, at times, and it depends on which geography we're talking about, where sometimes service is behind sales, sometimes it's ahead of sales. This is, Tesla's growing, I believe, faster than any company in history that makes a large, complex manufactured object. So, these are, if you're trying to max, it's always difficult to match exponentials. But I think it is helpful to have the feedback loop with a service, because that means we feel the pain of service, and then we can adjust the design to make the car need less service. And I think that gives us the right incentive structure, because the best service is no service. The car doesn't break. And whereas if you have, say, a dealer network that is reliant upon service as a revenue, then you arguably have a misalignment of incentives, where they're making money on service, but actually we want to, the best thing for the consumer is the car doesn't need servicing.
I agree with Elon 100% on that. I don't have anything really to add of value. So that's it. That is our show this week. I want to thank Gene for raising his pledge, and I want to thank Scott for becoming a patron. Thank you both so much. It's really kind of you. It helps out a lot. All of the money goes back into the show. None of the money goes into my pocket to pay for, my personal expenses. I have a job. My wife has a job. So thank you for doing that. I really appreciate it. All right, everybody. Next week, we're going to talk about Rivian, and then we have news on Friday. So Tuesday, Rivian, news on Friday. Thank you so much for listening. I hope you all have a wonderful day, and I will see you next week.